I'm Professor Indra Desekar. Let's look at accounting for primary financial instruments. We look at three aspects. We start with what are financial instruments. Then we will look at how to recognize financial instruments. And finally, we will look at how to account for primary financial instruments. When we talk about financial instruments, there are two types of financial instruments, primary and secondary. When we talk about primary financial instruments, we are in fact referring to financial assets, financial liabilities, and equity. The secondary financial instruments, which are also called derivatives, either comprise of contracts, and these contracts could include forward contracts, futures contracts, options contracts, and swaps contracts. And then there's also another category called convertible equity. In fact, it's an options contract. It's a specialized options contract. When we talk about primary financial instruments and secondary financial instruments, under the primary financial instruments, apart from the conventional financial assets, financial liabilities, and equity, in relation to treatment of these assets and liabilities, there can be special situations which we will look at later. So what are financial instruments? So financial instrument is any contract that gives rise to a financial asset in one entity So when we talk about financial assets and financial liabilities, financial assets means those items which are cash or cash equivalents, like contractual right to receive cash, investment in equity, investment in a second financial instrument that's favorable to the entity. Examples are accounts receivable, loans receivable, cash. The financial liability mirrors financial assets. Their contractual obligation to deliver cash or issue equity or an investment in a second financial instrument that's unfavorable to the entity. So examples of financial liability: accounts payable, loans payable, finance lease liability. So let's look at an example of financial assets, financial liability, or equity. On the first item, company A issues a debenture to company B, so which means company A has a financial liability. Company B, because it's investing in company A, debenture, it has a financial asset. Second one, company A invests in company B to acquire ownership, so company A has an asset investment and company B as issued equity. So asset and equity. The third one, company acquire option. So it's a contractual right. So that right is an asset. So A has an asset to buy shares in company B. The contractual agreement states that the company C will acquire company B shares from company A. So company C has an obligation to deliver equity to company A. So therefore company B has a financial liability. But company B, although it is shares that's been given to company A by C, company C, company B has no obligation or no benefit through this transaction because those are shares that are acquired in the secondary market by company C to give it to company A. So in situations where a given entity has financial assets and financial liabilities of another entity, these financial assets and financial liabilities can be set off and the net amount could be shown for reporting purpose only if that there's a legally enforceable right to set off the recognized amounts and also there's intention to settle the financial assets and financial liability on a net basis. Otherwise, the requirement is that the financial assets and financial liability, although of another entity, same entity, has to be shown as separate items. If you look at another example, company has recorded 700,000 accounts receivable and 500,000 accounts payable, and in that company owes 100,000 and owing 150,000 to company B, and both will be settled on a specific day. And what is the accounts receivable and accounts payable? Obviously, meeting those obligations to set off, we can say that the net owing is 50,000. So that net owing is 50,000. We can take off 100,000 from accounts receivable, take off 100,000 from accounts payable. So as a result, the net obligation becomes 50,000, and that 50,000 could be included. So in fact, our accounts receivable will be 600,000 and accounts payable would be 400,000, and the 50,000 net amount is included in the accounts payable. Now that we have a basic understanding of what are financial instruments, primary financial instruments, let's look at measuring primary financial instruments with a focus on financial assets. So when a financial asset is acquired at the time of acquisition and recording, there's initial recognition, and thereafter the financial asset is subjected to review at each reporting date to ensure that the amount that is shown is accurate. So after initial recognition, we have to ensure that the financial asset shown is correct. So we can use fair value as a measurement to ensure that the accurate amount is shown in subsequent period. So fair value is a value that is determined in an orderly transaction, not a forced transaction. So there's usually custom market-based transaction. There's market participants who are independent of each other, who are knowledgeable about assets and liabilities, and are able to and willing to enter into the transaction. So we talked about the recognition of financial assets. The initial is the fair value. And in subsequent periods, when we want to review and restate its value, there are three techniques that are available. And these three techniques are driven by the business model test. Based on the purpose for which these financial assets are kept within the organization. So there are three techniques. One is amortized cost. We use that technique if the financial asset is held to obtain cash flows. Second is fair value through other comprehensive income. That is when the financial asset is held for cash flows but will be traded at a specific date. On the other hand, the third is the fair value technique, where the change in fair value is recognized through as profit or loss. This is where the financial asset is held for trading purposes. So there are three techniques. Held to the asset held for cash flows. Then we use the amortized cost method, or asset held for trading purposes. Any change in the market value of the asset is recognized as a gain or loss in the income statement. And the third is asset is held to benefit from fair value and also and will be traded on a specific date, and it's also held for cash flows purposes. Then the gain or loss is shown in other comprehensive income section, and that other comprehensive income will be taken to the balance sheet in the equity section as part of equity. So we talked about the business model test, but when we apply the business model test and determine one of the three techniques for every revised value, for the revised value on subsequent dates to restate the financial asset, then we have to look at two aspects. One is, how does the company manage its financial assets? And second is, are there contractual cash flow characteristics of this given financial asset? So in choosing the technique, we use the business model test, but we must back it with evidence. So when we want to use the amortized cost method, which is the first one we looked at for the subsequent measurement, there are two conditions that must be met. We talked about the business model test and the cash flows. First is that the asset is held to collect contractual cash flows. And on the cash flow test, the cash flows should be received at specific dates with a principal repayment amount and an interest income. So for the subsequent measurement, there are three techniques based on the business model test. The first one we are going to look at is the amortized technique. So in this example, ABC acquired bonds issued by XYZ. So ABC has a asset, financial asset, and we've been told the face value is 10 million, coupon rate is 10%, bond will be settled in 4 years' time. At the time bonds are issued, the market interest rate for similar bonds is 8%. So ABC Limited, based on its own evidence, have determined that they are going to keep this bond for cash flow purposes. And there are no direct costs in acquiring bonds. And first, we need to calculate the acquired price of the bond and prepare a schedule showing opening present value balance, interest income, interest payments, and coupon rate, principal repayment, closing present balance, and then write journal entries for different periods. So there are periodic interest receipts over 4 years of 1 million. We need to discount that forward cash flows based on the market interest rates because it's based on the market reality. And the cumulative value for that is 3.312124. And then there's a final settlement of the face value of the bond at the end of the 4th year based on market reality. The discount rate is 0.73500297. And the present value, the total present value, is 10,662,420, which is the investment that the acquirer will make in this bond. So based on this, in part 2, we prepare a schedule. So our opening balance is the acquired amount. And then there is interest payment or the interest received by the acquirer based on the contract, and that's 1 million. It's a constant amount across years. But the interest income should be based on the market realities and based on the brought forward value of the bond. For 2021, it is 852,990, which means the interest cash receipt is greater than the interest income that should have been received. So there's excess cash that has been received. So therefore, we decrease the brought forward bond value by that to come up with the carried forward bond value. So for the next year, for 2022, the brought forward bond value becomes 10,515,410. So likewise, we complete the schedule, and at the end of the 4th year, there is interest income, there is interest cash receipt, and then there is excess amount of 185,170. But that 10,185,170 is the final amount that will be received. That includes the 10 million plus the additional 185,170. That amount is the additional cash that should have been received, that was received in the fourth year. So the closing present value becomes 0. That means the bond is now settled. So our journal entries, looking at the schedule, we can complete. Right at the beginning, we record the investment, and then in the subsequent periods, we record the cash receipt and the interest income, and then the excess amount that's going to decrease the investment in bonds. So therefore, that's shown as a credit amount. So 2023 and 2024. 2024 is the fourth year. So we can see that we record the normal journal entry, and there's excess bond cash of 185,170. And then finally, the investment in bond is being paid out in cash, and the acquirer receives cash at end of the fourth year. We are now going to look at a second technique, fair value through profit or loss. So the rule is that fair value must be used as the basis to measure the financial asset. But we use it if the asset does not pass the amortized cost application test. And second, all equity instruments must be measured at fair value, because cash flow characteristics do not apply to them, like financial assets and financial liabilities. Those cash flow characteristics do not apply to equity. So here's an example. So under this technique, the financial asset is held for trading, and we measure the change in the fair value, and that change in fair value is reported in the as profit or loss in the income statement. So A Limited acquired shares in B Limited, and there's at a given price $10 each. There's brokerage fees, and then in the closing period, the share price has now increased. So let's look at this example. First journal entry at the date of acquisition is to record the investment, but because it's a trading financial asset, the brokerage fee becomes an expense, and in the next period, the increase in fair value is recorded to increase the investment, and the gain is shown in the income statement. Let's look at the fair value through other comprehensive income technique. We take the same example. Here, the investment will include the brokerage fee. The reason for that is that it's held for cash flow purposes, and although it will be traded at a specific date. And the increase in investment in the subsequent period is recorded against the other comprehensive income, which will be subsequently transferred to the cash flows reserve on the balance sheet. So let's look at two special situations now. The first one is where a company offers an interest-free loan, for example, to a staff member. Although it's interest-free loan, the market interest rate for such loans, let's say 6%, and this loan is for 3 years. In that situation, we have to discount that loan, taking the market-based interest rate, and at today's value, it would be 83,960. So let's look at how we record this transaction. The first one is that we have to discount the loan to present value using the market-based interest rate of 6%, which means the value of the loan in present terms is 83,960. So we record the value of the loan, and the cash that was paid out was 100,000. The difference becomes an expense to the organization for the benefit it provided to the employee. In the subsequent period, although it's interest-free loan, the company is supposed to receive an interest income based on the loan value, outstanding loan value. So that's 83,960 at 6%, and that amount becomes the loan receivable. So the loan receivable, which is recorded as 83,960, now topping up with every year. So for the next year, 2022, the interest revenue is based on the loan receivable that's brought forward. So that loan receivable has now increased from 83,960 plus 5,038, and the interest revenue is calculated, and then there's a loan receivable for that period. So gets topped up again. So likewise, for 2023, the interest revenue is based on the brought forward loan receivable, and then there's another new loan receivable that gets added to the loan receivable cumulative amounts. And finally, again, there is on the final year of the settlement, there's interest revenue and loan receivable and loan receivable. So all that adds up to the loan receivable to make up 100,000, and that loan is now paid out by the staff member, and company receives cash 100,000. Next is the gains and losses of financial liability. Next is the gains and losses of financial liability as a special case. Financial liability is measured at fair value. Any gain or loss portion relating to the expected credit risk of the loan must be shown under other comprehensive income And an exception to this include all as profit or loss is allowed only if there would be an accounting mismatch that is determined at the beginning of the transaction period. The financial liability must be measured at cost, and any gain or loss, if the financial liability is measured at cost, any gain or loss is shown as profit or loss. So one important addition or improvement to the financial instruments accounting standard is to change the credit risk situation from incurred credit risk to expected credit risk or loss arising due to expected credit risk. So I'm going to now play a video for you. When you watch the video, I want you to think about what are the three different aspects covered by the International Financial Reporting Standard 9, financial instruments, and what was the change in IFRS standard did on credit loss recognition as a response to the financial crisis.
In July 2014, we published our new financial instrument standard, IFRS 9, and it covers three different aspects of accounting for financial instruments. Firstly, how they're classified and measured. Secondly, how impairment or expected credit losses are accounted for. And thirdly, hedge accounting. Now, the first two parts of IFRS 9, classification and measurement, and impairment, were very much our response to the financial crisis. So, for example, on classification and measurement, we've changed the requirements in IFRS so that when an entity's credit risk increases, they don't book gains in profit or loss as a result. On impairment, we move from an incurred loss model to a more forward-looking expected credit loss model. Now, the third part of IFRS 9, hedge accounting, isn't really a direct response to the financial crisis, but what it does do is requires people to provide better information about their risk management activities, which helps them inform the users of their financial statements. In IFRS 9, we changed the accounting for impairment of financial instruments from a so-called incurred loss impairment model to an expected loss impairment model. Now, this is a really important part of our response to the financial crisis, because during the financial crisis, people raised concerns that the accounting for impairment resulted in booking loan losses and loan loss allowances too little too late. So what IFRS 9 does in moving to an expected credit loss model is really two things. Firstly, right from when an entity lends money, it starts to account for its expected credit losses. It doesn't wait until an event happens before it does that. And secondly, when expected credit losses are measured, they are measured using all reasonable and supportable information that's available to the entity, which includes not just their historical loss experience and current information, but also their forward-looking expectations based on reasonable and supportable information. Now, during the financial crisis, people told us that there were circumstances when they expected losses to arise in the future, but they weren't able to take into account that forward-looking expectation. So IFRS 9 is very much designed to address that concern. The other part of the impairment model in IFRS 9, which is really almost as important as the measurement and recognition requirements, is the disclosures that come with it. So there's a lot more information provided to users of financial statements about the financial instruments that are showing credit risk that's what the entity would have expected when it lent money, and separately information about financial instruments that are performing worse than was anticipated by the company, and information about the sort of absolute credit quality of their financial instruments as at the reporting date. So the combination of the more forward-looking model and that richer set of information should enable people to much better understand the real credit loss expectations of reporting entities. So we published IFRS 9 some time ago now, back in July 2014, so over 18 months ago, and it's still only effective in 2018. So sometimes people think that seems like an awfully long time between when we finished our job and when people start to show the changes in their financial statements. But we made a very conscious decision allowing such a long lead time, and the reason for it is that we know that preparers, and particularly those in the banking and insurance industries, have got to make changes to their systems to put in place these new expected credit loss impairment requirements, which are a big change in accounting. So while it's been quiet for us for the last 18 months or so, for the preparers, they've been very busy, involved in their implementation and planning processes, and working with audit firms and prudential regulators to talk about the changes that they're putting in place to implement the new standard. Whenever we issue a new standard, particularly a major one, we're always interested in the implementation process that people are going through, and also whether any interpretation questions arise in implementation. So, as is always the case with the new standard, we've been involved in conferences and discussions and outreach activities, talking to people who are implementing IFRS 9, and particularly talking about the expected credit loss requirements because they're such a big change in accounting. But what we did when we published IFRS 9 was, at the time we actually published, we announced that we were establishing an implementation group, a transition resource group as we call it, to help with the implementation of IFRS 9. And it was really because we knew that people were going to have to make big systems changes, and it was such a big change in mindset that we took this relatively unusual step. And what the Transition Resource Group is and was is a group of experts in credit risk management who met in public to discuss questions that were submitted by people implementing IFRS 9 that we thought would help people understand the requirements of IFRS 9, give confirmation of what the requirements are, and also provide a forum where people listening could hear the types of approaches people in practice were taking to implement those requirements. So the ITG met 3 times in 2015 and covered a whole range of questions, which provided, I think, a lot of educational assistance for people, and we didn't actually identify any areas where we felt we needed to make changes to the standard itself, which was a good confirmation for us. Now, we don't plan at the moment to hold any more transition group meetings on impairment, but we do still have the group in place, and people can still submit questions if they have them through our website. So we stand ready, if you like, if people need help with the implementation process. So IFRS 9 sets out the expected credit loss requirements for financial instruments from a general purpose financial reporting perspective for entities that are applying IFRS. And that's separate to what the prudential regulators might require to be calculated for capital adequacy purposes. But we do have a very close relationship with the Basel Committee, and one thing that they have done is put in place some guidance on what they consider to be best practice for banks applying IFRS 9, what their expectations would be, particularly for internationally active banks, the more sophisticated banks, when they're working out expected credit losses. And we often get asked whether we see that as a positive or not. And from our point of view, we see that as very much complementary to IFRS 9, so it really sets out their view on what's a good application of an expected credit loss model. The Enhanced Disclosure Task Force, which is a group that was established by the Financial Stability Board, have also done some work, and they've updated their recommendations on what would be good practice for disclosures in the context of an expected credit loss model. Again, that's not mandatory and it's not an IFRS requirement, but it's another set of information which is helpful for those applying IFRS 9 to look to as best practice, if you like, when they're thinking about what disclosures might help users of financial statements understand the expected credit loss requirements in IFRS 9. So in terms of looking forward, we've finished what we are going to publish on financial instruments for the moment in terms of IFRS 9, so there's a stable platform, if you like, for people implementing IFRS 9. Having said that, we're still interested in the implementation activities that people are undertaking, and if people did have extra questions, there's still the ability to submit them through our website. And as I said, the Transition Resource Group stands ready in case we need to use them. The other thing that's still happening on financial instruments is the work that our US counterparts, the Financial Accounting Standards Board, is undertaking. They recently published new requirements on classification and measurement, which importantly include own credit changes, which are very similar to the ones that we've put into IFRS 9, again resulting in gains and losses not being recognised as a result of changes in an entity's own credit risk. And then we expect the FASB to publish a new impairment model shortly in the first half of 2016, which, like ours, is a move to a more forward-looking expected credit loss model with differences in detail to what's in IFRS 9, but a lot of commonalities, particularly in the information set that's used to measure expected credit losses.
Financial instruments got into this video, and what was the change IFRS standard did on credit loss recognition as a response to the financial crisis.